Hey there, everyone. Today on the final bar, happy Monday. The S&P 500 and the NASDAQ both up over 1%, with consumer discretionary stocks leading the way higher. Bitcoin spikes to 30,000 on false news that a Bitcoin ETF was approved. What does that tell you about the upside potential when that news actually comes to fruition? Finally, we'll have a live Q&A today on the show after our market recap. Prepare to have all your questions answered. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. Happy Monday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical analysis process really involves analyzing price, analyzing volume, analyzing sentiment and survey data, all with the goal of understanding investor psychology, reflecting on the buy and sell decisions that individual investors and institutions make, how those sort of bubble up into the broader price movements that we can analyze. And by thinking about momentum shifts, what we call a change of character, a lot of times you get early warnings that things are starting to rotate. Now, we've been in a choppy environment for quite some time. In our market recap, we're going to look at some of the signs of the time, sort of the overall trends where we've come from, what happened today as we set up for a heavy earnings week. Schwab is one of the names we're going to look at today, already reacting, reporting before the open today. A lot more to come with stocks like Netflix and Tesla and others reporting as well. We have a live Q&A wide open. We're going to do a brief market recap and then we'll get into the questions. So get your questions in now as I'm going through the market recap. Any questions that come up about technical analysis, about technical indicators, about the StockCharts platform, particular tickers that you want to go through, just pop them in the chat now. Once we get to the live Q&A, we will go right there and answering as many questions as we can before the end of the show. Let's get to our market recap and talk about what happened today. Before we get to today's charts, we will answer a poll question that we asked all of you. Perfect time for this question, by the way, with Bitcoin spiking on the news this morning. Where will Bitcoin be 1 month from today? At least 10% higher, at least 10% lower, somewhere in between. Look at how widely distributed the responses are here. And I think that tells you all you need to know about the current situation with Bitcoin. It is super unclear. There are times, and I will tell you this, with stocks, with cryptocurrencies, with other assets as well, there are times when things seem super straightforward. And I talked to some of my guests last week about something like the S&P, right? 2021, now looking back, seemed incredibly easy because it was sort of a very straightforward, consistent bull market phase. Sort of mid-2022, pretty clear, right? You could see all the signs of deterioration, all the weakening conditions. It was pretty reasonable to expect further downside as the trend persisted. Now we're sort of in this weird limbo period, right? The S&P between two moving averages, Bitcoin sort of range bound, right? Sort of between 25,000 on the lower end, 31,000 on the upper end. We remain in the middle of that range. So I think with a lot of charts, we're waiting to see which way we break. Tesla may be one of the best examples of that right now with a coil pattern leading into our earnings. I think that's Wednesday after the close. Where would I say about Bitcoin? I would probably say between 0 and 10% higher, only because I don't see enough evidence on the chart yet for a big upside move 10% plus higher. However, you're seeing signs of accumulation, right? You're seeing more signs of accumulation than not, I would argue. Let's look at the chart of Bitcoin here very quickly, and then we'll get to the broader markets and what has happened. As I mentioned, there's a news flow, and if you missed this, what happened is a website, Cointelegraph, came up with an announcement on their social media accounts. I think it was on X, mentioning that a Bitcoin ETF was approved. They quickly retracted that, but the market spiked very quickly. It was widely covered in a lot of traditional news outlets that sort of propped up this news. It ended up being a false story, and as we're going live, it's still unclear as to what exactly happened. But I'll tell you what did happen is Bitcoin spiked. And what's funny is almost to the penny to $30,000, right? Look up here where we spiked literally up to this horizontal trend line. We have trend lines at all the 10,000 markers, right? 20K, 30K, 40K, because more often than not, I found so many times when Bitcoin and other big cryptocurrencies hit those big round numbers and then reverse. So interesting to me that we spiked right up to 30,000 and then came off quite a bit. So, when I talk about, between 0 and 10% higher, you figure that's around, 3,000 higher. That basically gives you between 28,000 and 31,000 over the next month. I don't think that's unreasonable because off of the low here around 25,000, we've now made a pattern of higher highs and higher lows. We'll see how today plays out. Today might be a spike, kind of a strange candle, but overall, I would say the path of least resistance remains positive. I'm also looking at the momentum down here. A lot of times we talk about the range of the RSI. Look at how the RSI has pulled back to 40 a couple times, now pushing above 60 on this rally. And again, we'll see if there's sustainability to this move or if it was just a one-off reaction to this sort of bogus news story. But overall, I would say for now, the trend remains positive. I'm inclined to think there's further upside to be had until proven otherwise. Might want to watch some trend lines on the recent lows on there as well. Let's get to the rest of the market recap. As I mentioned, nice update. The NASDAQ composite, the S&P 500, the Dow, all finishing in the green. The NASDAQ was up 1.2%. That's 160 points. The S&P 500 up just over 1%. And that gets us to just below 43.75. We've talked about that 43.50 level. That's the neckline of that head and shoulders topping pattern. Now, after breaking down through that neckline, we sort of pushed a little bit further. We came back above the neckline last week. Then we kind of went below it. And now we're once again sort of toying with that potential level of support or resistance. So really kind of a magnet price, or what we might call a pivot price for the S&P 500. The Dow finishing up by about 1% as well, getting to just below 34,000. Mid caps and small caps doing quite well relative to the S&P. The S&P small cap 600 index up 1.8%, which is a nice upside follow through. The VIX actually pulling down by 2 points. So the VIX is really noisy right now. There have been periods where the market has been moving higher. I'm thinking of like 2021 on very low volatility. This is not one of those environments. We're seeing big swings in the VIX. You're seeing big swings in the MOVE index, which is basically volatility for the bond markets. You're finding high yield spreads widening out. So this is certainly a period of uncertainty and the volatility of the volatility, right? The VIX of the VIX, pretty high right now, I would say, right? The noisiness in the VIX reading, pretty significant. All of that does not tell me about a calm period of accumulation. This is more of a transition period, a period of uncertainty, and that's certainly what the charts are telling us if you look at some of the broader index charts as well. Some other asset classes here, the rates moving higher overall. 10-year yield, the 5-year yield just about 4.7%. 30-year yield finishing today around 4.87. The short-term end of the curve, of course, pretty high relative to the mid and long-term points. The TLT pushing lower by about 1.6% to 86.20, just below that. And what's interesting is that trend in the TLT has been continuously lower. We had a question in our mailbag last week. I want to say that was on Friday about, how long can the TLT go down? And my short answer is a lot longer than you think. And a good reminder, never confuse the bottom of the page with support, never confuse the top of the page with resistance. Just because something has been going down a lot doesn't mean it can't continue much, much lower. And market history is filled with those sort of trends and persistent trends, probably much more than you'd think are reasonable. The dollar index down by about 0.4%, so the UUP pushing a little bit lower. That strong dollar has been an interesting factor, and the trend in the dollar has certainly been positive. One of my guests last week, Adam Turnquist, talked about earnings season as we really heat up with earnings this week with a bunch more financial firms, really a number of different sectors represented in this week's earnings. Strong dollar could very much be an impact. And when you think about mega caps leading, mega caps are the companies, the multinationals are the ones that really have to deal with the dollar strength or weakness because they're paying employees in other currencies, because they are converting profits back to different currencies. And so that is a real factor. So stronger dollar could certainly be a factor in the earnings. Something to watch as we get some of the earnings calls and earnings reports through the course of this week and really the next 2 weeks as well. The commodity space, a little bit mixed, but overall more negative than positive. You can see gold and silver both down about 0.5%. The GLD tipping just below 178. The broader commodity space as measured by the DBC, which is a broad commodity ETF, down about 1/3%. The USO, which is a crude oil ETF, down about 0.75%. Finally, cryptocurrencies, as I mentioned, kind of a noisy session here, of course. It's sort of an interesting development when you see a spike in something like Bitcoin, quickly looking to see what's happening and try to make sense of it. Turns out it was an initial reaction to a news headline. And, we've talked about the bull case, the long-term bull case for cryptocurrencies, which I do believe in, involves broader adoption of cryptocurrencies and broader adoption certainly by institutional investors, by people like financial advisors, individual investors, having the vehicles that they need to actually express a point of view on Bitcoin. A lot of, my dad is probably not going to open a digital wallet and accumulate some Bitcoin or Ethereum, but I could see him and others of his age bracket buying a Bitcoin ETF because it's an ETF like anything else. And I think what you saw from the spike today is just validating that general thesis that when you get more and more vehicles that are traditional ETFs, more like the GLD for gold, but for Bitcoin, there certainly could be some upside there. For now, Bitcoin is up about 5%. It's just below 28,500. Ethereum was just above 1,600, just gently below there, still up about 2%. The rest of the cryptocurrency space, for the most part, still in the green. We'll see what happens as we digest the aftermath of this news headline. But again, overall, I think the trends in Bitcoin and Ether for now, fairly consistently strong. Finally, looking at sectors, the XLY and the XLC, number 1 and number 2. The XLY, consumer discretionary, up 1.6%, closely behind the communication services sector, up 1.5%, followed by industrials, real estate, utilities, consumer staples, all about 1% positive for the day. On the downside, you'll note none of the 11 S&P sectors in the red, but you have energy, healthcare, materials sort of lagging behind the broader S&P 500. So, a little bit of a different feel. Last week, we had a couple days where the market was higher, but defensive sectors like utilities and real estate way at the top. Today, more of a traditional configuration with XLY and XLC, two sort of growthy leadership sectors at the top of the list. Let us go to the daily chart of the S&P 500 and see how things played out. So I mentioned we're sort of chopping around. This is, one of my guests, Sean McLaughlin, calls this the sloppy choppy phase, and I think that's sort of where we're at right now. If you think about what the market has been telling you over the last 3 to 4 weeks, I think breaking down through the neckline was significant. I think breaking down through this green trend line was significant. The last thing we're looking for is, do we break below the 200-day moving average? A lot of my guests have been keying in on that level, as have I. I think that's an important one. Not surprised that we bounced off of there about a week or two ago. If you look at what happened since then, of course, as we mentioned on Friday, Thursday shows as well, we're sort of in that limbo period between a descending 50-day and ascending 200-day. One of these is going to break probably pretty soon. I wouldn't be surprised if the direction of that break really completes the rotation. And I'm watching on the S&P as well, this trend line from the July, August, September highs, currently right around, we'll call it 44.50 as of today. But as you follow through, getting above the 50-day, getting above that trend line would be sort of the bull case from here, and would really open up the door to a retest of 4,600, if not further highs. A breakdown below the 200-day moving average, I think getting back below trendline support, below the neckline, getting below the 200-day really completes it. So just like Tesla sort of in this symmetrical triangle, this coil pattern, you see with the S&P sort of that pattern as well. But note the momentum, and again, that's where I sort of go back to what other evidence can we tease out? The breadth conditions, I would argue, are still more negative than positive. The momentum is still more in the bearish range. I'd want to see a rally with improving momentum much beyond what we've seen now with the RSI right around 50. That's sort of middle of the road. That's not a great number just yet. Just to finish off our market recap here, I'm going to look in our Mindful Investor live chart list. One of the charts that we like to look at is called offense versus defense. We had a great question about this particular chart last week in our live Q&A. And as a reminder, we're going to go to the live Q&A here in a few moments. So if you have questions on your mind, anything that we've gone through so far, or anything else that's come up on your analysis of the charts, pop it in the chat room or in the chat now, and we'll get to as many questions as we can here in a few moments in our live Q&A. When we're looking at offense over defense, this is the cap-weighted version, XLY versus XLP. This is the equal-weighted version, RSPD versus RSPS. Those are equal-weighted ETFs tracking those same two sectors. Note how both of these are still arguably going up. They're still making higher highs and higher lows. Neither of these have broken down, and I've sort of indicated this support level that we've held above here. So while the breadth conditions are still negative, offense over defense still favoring offense. Now, one of the questions we got was, but the XLY doesn't look particularly good, and that's fair, right? Here's the chart of the XLY. If you look July through mid-October, we're going down, right? Lower highs, lower lows. I think very noteworthy here in early September. After Labor Day, we rally higher, unable to eclipse the July high, and then we make a new swing low. So that's more of a negative rotation. But here's what the XLP looks like, a lot worse. And right, even though we're using different scales, I mean, you can just tell visually, these are two different charts, right? From something that looks a little more like the S&P, sort of a gentle decline, versus something like the XLP, which appears like it's getting bombed out and rotating much lower, much more quickly. But I would stand by the idea of that ratio analysis, right? That first chart of the XOY and the XOP doesn't tell you the absolute returns in either series. But the most important thing is not the absolute movements. It doesn't matter as much with this particular type of analysis whether the XOY is going up or down on absolute terms. It's all about the relative performance. If you think of this as a zero-sum game, which I know it isn't, but that's kind of what we're implying here, are investors rotating more to offense or more to defense? What this chart is telling you is that they are leaning still into offense over defense. And it's not just Amazon, Tesla, Home Depot that are dominating that, which has happened at times. The equal-weighted version is still very much favoring the offense because the defense is getting beaten down so much right now. And some of the food products names, grocery stores, others really sort of struggling, particularly on a relative basis. That's what's causing this ratio to go higher. But as long as the ratio goes higher, it tells you just things aren't getting that bad yet. But that's why I would be watching that chart very closely as we continue on in the fourth quarter and start to get through our earnings as well. That's it for our market recap. Again, thanks everyone so much for joining me for this so far. As a reminder, we're going to have our live Q&A in a few moments. The way that we do questions now on the Final Bar, we give you a lot of different ways to get your questions in front of us, and we welcome them all. As you're watching our show on any given day, as long as we're going live, you can pop a question in the chat. We'll either get to it live like we will today, or we'll put it in the mailbag and get to them as soon as we can. We also have comments below our YouTube videos, so don't forget to like our video right now if you wouldn't mind, and subscribe to our YouTube channel while you're there, because that will make sure that you can join us for the next live broadcast as well. Comments below we will always capture. And finally, you can give us an email. thefinalbar@stockcharts.com is the best way to get your questions to us at any time of the day or night. On Twitter/X, you can just tag us in a comment at FinalBarSCTV. Again, thanks so much, everyone, for supporting us, supporting the show, and watching StockCharts TV. We got a lot of really good plans for the Final Bar, and excited to continue to bring you good content. Let us get to the chat here. Let me pop this up, and let's get to some of the questions. I see a number of questions here in the live chat. Thanks so much. Keep them coming. We'll get to as many as we can, and anything we don't get to, we will put it in the mailbag and get to it as soon as we can. First question, Trevor, could you recommend one or two mean reversion trading strategies that you would find interesting if you were looking for a short-term strategy, both short and long? Really good question. And what I love about it is in the question you are showing an understanding of timeframes, which I think is really important. A lot of times I get a general question on what indicator should I use for selling or something like that. My initial response, as always, is, well, what's your time frame? Are you looking at the next couple minutes or the next couple years? Because that means the types of charts, the types of indicators probably very, very different. When I'm thinking of a stock that is in, is in a particular trend, I'm trying to come up with a good example. When I'm thinking of a stock that's in a particular trend, for example, like an Intel, right? That overall this long-term trend is still positive, but you can see a lot of these short-term swings sort of up and down. So you have a couple choices if you're in more of a swing trading type of strategy. And you applied a short-term strategy. So for me, I'm going to generally assume that's like a swing trading strategy, not a day trading, which is kind of moment to moment, minute to minute. I'm thinking more a couple days, maybe a week at a time, and just sort of betting on, no more than a couple trades a day, I guess, to sort of manage those swings. So the first thing you want to remember is, in general, you want to tighten up your timeframes of your charts. So we are using a lot of 2-year daily charts because in general, we're thinking a little longer term. You'd want to dial that down to like a 6-month daily chart. Even looking at hourly charts as well, which could help you with certain stocks and ETFs. Of course, understand that shorter term time frame that is influencing the daily time frame. When I'm thinking about these price swings, 2 indicators that are sort of my go-to that I would do. Number 1, I would do RSI, but I'd probably tighten up the time frame. And I would use MACD or PPO. Now, if you'll notice what I did, I quickly sort of adjusted the settings on here. And that's something you might want to remember. The indicators that I use, like RSI, we showed on the show every day, really, as we're on here. We always use a 14-day RSI because for the time frame I'm working on, that usually makes a little bit of sense. But if you're more of a swing trader sort of time frame, if you're looking a little shorter term, I would dial down the parameter. So I'm looking at a 9-day RSI. You could even do a 5-day or even a 3-day, depending on how actively you're trying to understand the price swings. because then what's going to happen is the indicator is much more sensitive. So when I go to a 9-day RSI on Intel, you can see all of a sudden the little overbought conditions mean something. The little oversold conditions mean something. And in general, if I can find an indicator that helps me to sell right about here, to buy right about there, to sell at these peaks, to buy at that low, you get the idea why an RSI on a shorter time frame really good for swing trading. And so if that's not the time frame I usually operate on, if I did, I would probably use a 9-day RSI as a starting point, depending on what type of assets I was looking at. And then something like PPO is really helpful as well. And you can see just on this sort of time frame, I was trying to think of something that's a little more swing tradey kind of setup right now. You can find that the MACD or the PPO pretty good at identifying some of these turns. Now, what happens is the RSI is more of a leading indicator. It's going to tell you when we're getting sort of into that bottoming period. The MACD or the PPO isn't going to fire a buy signal until the trend's actually rotated. So by using two different indicators like this, one a little more leading, one a little more lagging, by adjusting the parameters depending on the volatility of the instrument that you're looking at. So if you're looking at, like a broad market ETF or a biotech stock or a cryptocurrency, I would adjust those settings. And again, the best formula is whatever works for that type of chart. And I would think about the volatility and the type of movements that the asset tends to show. That's how I would select some of those indicators. So that would be my question. I would use a 9-day RSI and a 12, 26, 29 PPO, kind of the standard settings, and I would adjust from there. But that, Trevor, is how I would go about that. And what's good about those is it is sort of both sides, right? It's a long and a short kind of built in. Some indicators are really only good for one side or the other. These two, I think, are probably more generally applicable to both sides of it. Next question, Procter & Gamble, and follow-up question, XLP are showing some strength. I knew that might come up here in the live chat, and thanks, Acorn, for mentioning that. Yeah, totally fair, right? And if you look, the trend over time now has been some of the consumer staple stocks have been absolutely crushed. Right now, of course, you're seeing some of them pop to the upside pretty nicely. If you look at the indicator that RSI that I love to use on here, what's interesting about Procter & Gamble is it's oversold. What's also interesting to me on a chart like Procter & Gamble is it's oversold right at the May low. And so you're finding a couple different indicators kind of lining up. I've not looked at Fibonacci retracements, but I'll do that here just to see where they're at. I wouldn't be surprised if it's some sort of, yeah, right, of course it is. How well would that work out, right? So here we go. So you'll also note that we're right at that 38.2% retracement. I kind of fudged this a little bit. Sorry, I was doing it quickly, but basically taking the October low, taking the August high. It's actually a little bit lower than I drew here, but forgive me for quick annotations while we're live on the show. It's probably more like this. But if you look, it lines up pretty well with the May low. It also lines up pretty well with this first Fibonacci support level. So the opportunity for a Procter & Gamble to rally from here totally makes sense. As you probably know from watching our show, I am much more interested in something like Procter & Gamble once the rotation has happened. So a day like today starting to get me interested. Up until today, I would argue this is a chart in a downtrend. There's no real signs of accumulation. Today with the gap higher could very much be it. This is a space where I think earnings could be quite a benefit when you think about some of the companies, and an earnings, a positive earnings release can work magic on a stock or on a chart that's been struggling for a little bit. So I wouldn't mind. I get the argument for a bounce for something like P&G here. I would probably be patient and waiting for a move above the 200-day and a higher low. Those are the things that would convince me, all right, this is the beginning of something more. But great note on XLP. I can't disagree today. That's something certainly to watch through the course of this week as well, particularly with companies like Tesla reporting that can adjust the XLY very, very quickly. All right, next question. Volume price analysis. Can volume of shares traded in a sector ETF such as XLK be used the same way as volume of shares traded in a stock like NVDA with regard to volume price analysis? Really good question. I would say anytime you're using volume, I've tended to think of ETF volume as pretty comparable. So I don't think you would need to do anything crazy because of that. I think you can go down a rabbit hole of confusion when you're thinking of ETFs or particularly funds and just the structure of them and how many shares are out there and what that actually represents. With something like ETF, I would think of it like a stock. It essentially trades like a stock, and I wouldn't think of it much differently. I think of ETFs, closed-end funds, and common stocks as kind of in that same bucket where I think volume has a particular meaning. The big caveat for all volume measures in 2023 is just the nature of what volume really represents, and that's why I would just put an asterisk behind anything volume oriented. And this is something we've talked about on the show before randomly. Years ago when I was learning technical analysis in 2000, decimalization was really just becoming mainstream. We're moving away from stocks trading on eighths and fractions as opposed to decimals. That whole change, dark pools, the close of regional exchanges, the growth in electronic exchanges, all of that I think has affected what the volume really tells you. I've talked with, when I was on the IBD podcast with Justin and Arusha, we talked about volume because volume is a big part of William O'Neill's toolkit and talking about the volume relation. We talked a little bit about that and how I think that's changed quite a bit. So if you like volume, which I get the argument for it, and I certainly, when you're thinking of patterns and breakouts and looking for volume to validate that, I think that's totally fair. And I would think of volume the same for an ETF as for an underlying stock. That's how I would generally think of it. Next question, VIX is tracing a head and shoulder. Interesting, let's take a look here. Let's go to the sentiment chart list. Let's look at the VIX. Head and shoulder. So I'm not sure exactly where you'll be looking at a head and shoulder pattern. Let me take out maybe a shorter time frame. Let's see what we can figure out here. So I don't see it. Maybe you're thinking of this as a head and this is a right shoulder. But the VIX, so the reason why, or maybe it's this, the VIX and the head and the shoulders here. So I don't think you can call it an inverted head and shoulders because this is some weird, freakish, multi-headed monster. But is this a head, left shoulder, right shoulder? I mean, maybe, but what you have to remember is the head and shoulder pattern is really meant to be a longer term pattern. I know a lot of people think of it on shorter time frames and on really long-term time frames. If you read the literature like by Edwards and McGee, written like middle 20th century-ish, they were very specific on the time frames that were attributed to those as a multi-month pattern, looking over a big period of time. It was really meant to highlight a rotation from one phase to another. So something like this where you're really only looking at like a 3-week period, I don't know if I would be comfortable calling that a head and a left shoulder and a right shoulder. Is it meaningful if the VIX breaks below this point, particularly gets below the 50-day moving average? That I would have I would be much happier eating that meal than the first one that you're implying with this being a right shoulder. I don't know if I could label it that way and feel really good about myself. Would it be meaningful if the VIX continues to go down and certainly gets back down to the mid-teens? 100%. I think that would be a significant rotation, particularly now as the VIX is testing 20. I think the main thing that I'm looking for right now is, does 20 hold? Do we get a little, and particularly again with events continuing to evolve, sort of a quiet period of sorts over the weekend with issues in the Middle East, this could quickly turn into something significant. And if so, I wouldn't be surprised if the VIX pops right above 20. For me, that would be a very defensive sign of, or sign of uncertainty that would tell me to get a little more defensive and just wait things out to see how things would play out. So that's how I would think about the VIX. Not as much about a head and shoulders top, but certainly happy thinking about the dynamics and what a drop in volatility could mean for sure. McKesson, I think, MCK, someone asked about. So what's great about the chart of McKesson is it's coming off of a new 52-week high. And there are not many stocks that you could actually describe that way, right? And you probably know if you watch this show how I would feel about a chart like this. I think this is a type of chart that's pretty strong. These are the types of charts we used to call long and strong, or up and to the right. Those are ideally, you have a whole portfolio of charts like this that keep making higher highs and higher lows. So in my checklist of a bull market, things are good kind of checklist, it would be the price is making higher highs and higher lows, which this is. It's above 2 upward sloping moving averages, which this is. The momentum is strong, which it is. The relative strength is improving, which it is. Those are the types of things that would make me feel really good about a stock that I owned in a portfolio. Things that would be early warnings of an uptrend sort of being exhausted. The RSI becoming overbought, not as bad as you'd think, because what happens is when a stock is going higher, overbought conditions often mean a short-term pullback might be ready, but it's not as much telling about a long-term reversal. That's where you're looking more for divergences. So the fact that we're making new highs on higher momentum, I would actually bucket it as a short-term pullback within a long-term uptrend kind of structure, which I think that's what we used to call the fat pitch chart, sort of like a nice pitch right over the plate. probably a pretty good bet. So, is the stock coming out of the overbought region, bit of a, maybe a bearish engulfing pattern today? If we look at the chart here, yeah, so a pretty clear one, right? You have an up day yesterday on Friday, higher open, lower close, it engulfs the first day. So these things, overbought, coming out of that overbought region, the bearish engulfing pattern telling you short-term weakness. But in my opinion, it's kind of setting up for this sort of move. And as long as we hold above the 50-day, that's not a bad chart at all. I'd be thrilled to have charts that have this general appearance in a portfolio. I think that's how you perform pretty well on a relative basis over time. So that's my take on McKesson. Holding above the 50-day moving average, currently just above 430, I think pretty important there. AFRM is a really good question. Thanks for asking about this. This is actually one that we featured. It wasn't this last month. I think it was for September. I think at the end of August, Grayson Rose and I put together 10 stocks to watch for September, and Affirm was one of them. It looked really good for about 2 to 3 weeks, and it was breaking above this resistance level. Super encouraging. Look at this support level here at the 200-day. We break out above 20. Pretty good. Now, the way that I tend to think of stocks like this is a good breakout as long as it holds the breakout level. So for me, right around here, as we're now bouncing back to 20 and then failing to hold 20, I think this is a good chart above 20, but below 20, I'd much rather go somewhere else and look for better opportunities. So not a broken chart, I mean, not horrible yet, but for me, I think the thesis on something like Affirm, which is one of the, I bucket it in as one of those sort of ARK Innovation Fund kind of emerging technology names, maybe a sort of COVID era name like Peloton and others. Chart like this is good when you get signs of accumulation. I think the breakout in late August maybe was part of that, but failing to hold that breakout level is damning evidence in my opinion. I like charts like this as long as they hold that breakout. So back above 20, I think this is a good chart. Below 20, I'd much rather go somewhere else and find a better opportunity. Next question, DBA making higher lows. What is your long-term view? Kevin, thanks for the question. DBA is an agriculture ETF. If you're not familiar with this one, anytime I interview Mish Schneider, it's kind of funny. Mish is awesome, by the way, and she's stepped in to guest host this show sometimes and does particularly well. She's a fantastic guest, really knowledgeable, really thoughtful, and one of the nicest people I've met in the industry. She hilariously brings up agriculture stocks at any point, even if I want her to or not. She can't help it. Now, she has a background of trading ag, and so she is very familiar with the space. So I found certain strategists, certain analysts have a sort of a sweet spot or particular area of expertise. I have learned to trust them and listen to them in that space more than anything because that's where they have a deeper experience. And talking with Mish more recently, she is talking about the seasonal trends. If you look in your Stock Traders Almanac, which I was flipping through this morning, shout out to Jeff Hirsch and the team there as always. Talk about materials doing really well starting in October through the end of the year. So we're kind of right at that sweet spot there. A lot of my guests have talked about the resumption of an uptrend for commodities. And we've seen that in some ways with soft commodities like agriculture, but also things like gold popping higher recently, crude oil, of course, with all the news flow around it. Think about the chart that I showed you earlier about swings and the chart of the DBA. Reminds me a lot of the chart of Intel, kind of the swing trading type of move, just these nice swings upwards and down, very tradable swings, to be honest with you. Coming off of an RSI around 40, coming off of a higher low, I love that kind of chart. This is the sort of thing that I think at this point, if you buy it here, you assume a return back to the previous highs. Sort of the stretch goal is you break above there and push even beyond. But you will know if you've watched the show before, higher highs and higher lows are a good chart. We did not make a higher high, but we're still making higher lows, and I think that's something to be excited about. A higher low with an RSI around 40, very buyable pattern in my experience. I like the fact that we just got back above the 50-day as well, so I'd be looking for a return back to those previous highs. I think this space is certainly an area to look through the end of this year, maybe the beginning of this next year as well. Let's see, what is a sample intramarket relationship indicator for risk on and risk off? Something to say, okay, I am short, long, or fishing. I'm going to assume you mean intermarket relationship, which would be the relationship between different markets. Intramarket for me means inside a particular market. I don't know if that's what you meant, so I'm going to assume, Gunnar, you meant intermarket, meaning different things related to one another. What would be something you would look for risk on versus risk off? Really interesting question. And I will tell you the reason why I'm struggling for a bit is because I have found the best answer for risk on or risk off for me actually isn't intra-market relationship. It's looking at the conditions for a particular market. And with something like equities, it's looking at measures of market breadth, right? So I would argue that would be my best measure of risk on versus risk off. My go-to indicator for something like that would be my market trend model, right? So that's what I designed that for, was to look at weekly S&P data and just say, what are the trends, right? And again, intermarket relationships, thinking about stocks versus gold versus agriculture versus the dollar versus interest rates, I tend to think of those in terms of headwinds and tailwinds, meaning there is a relationship that tends to occur, but there are always sort of extenuating circumstances in life and in the financial market. So things often don't have a scripted relationship that is as tried and true as you think. And I remember reading John Murphy's book originally when I was studying for the CMT exams a couple years ago, and I remember him talking about these relationships. And there, in earlier editions, there was this implication that it was more static, right? If bonds do this, stocks do this, and that's how I thought of it. What I've learned in practice in subsequent editions, John Murphy really talks about the fluidity of those relationships. Bob Prechter has done a really good job in his presentations talking about how stocks and gold sometimes move differently, and then they sometimes move together. And that's just the nature of those changing relationships. If I had one sort of intermarket relationship that I would probably look at, I don't know if this totally answers your question, but it gets to one of the charts I'm going to feature here in a few moments, which is looking at stocks versus bonds. I mean, I think one of the things you have to remember is there is this sort of thing, this idea that has been profligated through the financial industry for decades, which is you need to diversify, right? 60% equities, 40% bonds, and that's kind of all that you need. I would argue a lot about what we talk about in the show is evidence that that is probably not the best use of your time as an investor. If you don't want to touch anything, you don't want to follow any news, that's what you should probably do. But if you do want to take an active role in the performance of your portfolio, you want to think about those relationships and how they're changing. The trend in stocks versus bonds is so clearly favoring stocks. So this is less risk off, risk on, but more about where do I want to be focused. And I am a big fan of diversifying into things that are working and diversifying away from things that are not working. I would argue active management certainly can work over time, but you have to have a process of layering into things that are working and layering away from things that are not working. That's what momentum investing really is based off of. So thanks for a wide-ranging answer to that broad question, but thanks, Gunnar, for asking about it. Last question, then we got to wrap the show. Today's action marks the 7th failed breakdown on the S&P with the weekly uptrend remaining intact. The NDX is forming a cup with handle on the weekly chart. Path of least resistance seems higher. Okay, let's take a look at the NDX on a weekly chart. Let me see this. Yeah, I get it. I won't disagree with that fact that this is a potential cup and handle pattern, but it's not ideal, and I'll tell you why. A cup and handle pattern has to have a really consistent rim. And what I mean is the left edge of the cup and the right edge of the cup need to be even. Now, some would say this is good enough because it's kind of a lower right rim, and this is a bit of a handle. I mean, maybe for me, I'm much more of a stickler in these need to be pretty consistent levels. So I wouldn't probably call this a cup and handle pattern. I would argue that if we break above 17,000, which would satisfy both of us, that would mean if this is a cup and handle-ish pattern, it's now validated because we broke above the neckline. In either case, I think you need to get above the November 21 high, which means we get to 17K. The NASDAQ above that level, no doubt bullish. What you have to remember is at this point, it's a potential cup and handle pattern. You can't assume that this is going to rotate all the way up to here and do it, because it hasn't done it yet. And that's what's important to remember with patterns like head and shoulders patterns, with triangle patterns, coil patterns, cup and handle patterns. They have a trigger. They have a setup, which is what we're doing now. They have a trigger, which is a level that until you do that thing, you can't really say it's a cup and handle pattern. It maybe is. It's a potential cup and handle pattern that's forming, but I'd need to see more evidence, and I hope you would as well. Great question, by the way, and I get the idea of the short-term weakness. Long-term could still be strong. I think we need to get to new highs to complete that rotation. Awesome questions, you guys. This is our first live Q&A in the final bar. I am optimistic at what we could do with this. Thank you guys so much for doing that. As a reminder, in the future. Use our super chat feature. Don't forget that, and we'll make sure we get to these questions. We're still working through this, and we will enjoy so much answering all your questions as they come in. Anything we didn't get to, we'll put it in the mailbag and hopefully answer it later this week. We've got to wrap today's show and go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Growth versus value. As I was going through a bunch of charts this weekend as part of my normal weekly routine, one of the ratios I was looking at was IWF, the growth ETF, versus IWD, the value ETF, and recognizing that growth is still outperforming value. Now, it's kind of a choppy relationship, June, July, August, September, but now completely rotating to the upside and breaking to a new swing high. Now, before you get all excited about this is telling you that growth is working and value is not, let's look at some other ratios that I think tell you more about what this is actually illustrating. If you look at the S&P 500 cap-weighted normal S&P 500 versus the equal-weighted S&P 500, you can see that this is going up. If you look at the mega cap, the Vanguard mega cap ETF, ticker MGC versus the SPY, you can see that is very clearly trending higher. These bottom two ratios are just looking at the largest stocks versus the smallest stocks, basically within the S&P 500, and recognizing that the mega caps are still dominating the returns here in October of 2023. So when I see growth over value, it's less that the conditions are great for growth. In my opinion, it's just that the mega cap stocks that dominate our thinking and that dominate our benchmarks are all in those growth sectors. And it's more about the mega cap stocks still being in the driver's seat versus anything else. Chart number 2, stocks versus bonds. I wasn't planning to get on this, but we got the question about risk on versus risk off. So I was compelled to share this ratio over time. Look at the ratio of stocks versus bonds from March of 2020. This is the COVID low. From that point on, it has had some brief pullbacks, granted, but overall, this ratio still very much favors the SPY over the TLT. Now, we can talk about a lot of different things about how we measure stock versus bond performance and a bunch of different things, but at the end of the day, the ratio is going higher, which means a 60-40 portfolio, 40% of that is in the part of this ratio that is getting crushed by stocks over the long term. And this is within bullish years like 21, bearish years like 22, and elsewhere. So when people ask me about diversification and how they should be, I am much more a fan of a momentum-based approach that helps you allocate to things that are actually doing well. The SPY stocks continuing to get it done over bonds. Finally, had some questions about cup and handles today, and they came up on the show. Just wanted to highlight what I would consider more of a traditional cup and handle pattern. This is News Corp, ticker NWSA. Nice move higher today, up about 4.7%, but this move completes that trigger, right? So a trigger for the cup and handle pattern. You have the big cup. Ideally, it would be more of a rounded bottoming pattern, but I think we'll take what we can get. Here, you have a shallower pullback here in September, and then a break above 2150, which breaks above this resistance level, which I would argue is sort of the rim of the cup and handle pattern. Now, when that pattern occurs, think about what that really represents. It means that this has been a ceiling in the market for months, actually over a year and a half. This has been the level, right? We've not been able to get above 2150. Now something has changed, which means anyone that bought News Corp over the last year and a half is now sitting at least on some small paper profit or else some significant profit as well. This is a very different environment when a stock is finally able to break out of a base to the upside, and strength tends to beget further strength in stocks. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. Thanks so much for doing our live Q&A. Appreciate you guys being engaged, asking some really thoughtful questions. We'll keep refining this, and would love your feedback, of course, on how we're doing. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.